Good day, everyone, and welcome to today's FRP Holdings call regarding acquisition of Altman Logistics. At this time, all participants are in a listen-only mode. Later, you will have the opportunity to ask questions during the question and answer session. Please note today's call will be recorded, and I will be standing by should you need any assistance. It is now my pleasure to turn the conference over to Chief Financial Officer, Matt McNulty. Please go ahead.
Thank you, and good afternoon, everyone. Thank you for joining the FRP Holdings, Inc. conference call today to review the company's recent announcement of the strategic acquisition of Altman Logistics. With me on the call is John Baker III, Chief Executive Officer, David deVilliers III, our Chief Operating Officer, John D. Baker II, our Chairman, David deVilliers Jr., our Vice Chairman, and John Klopfenstein, our Chief Accounting Officer. First, let me run through a brief disclosure regarding forward-looking statements and non-GAAP measures used by the company. As a reminder, any statements on this call which relate to the future are, by their nature, subject to risks and uncertainties that could cause actual results and events to differ materially from those indicated in such forward-looking statements. These risks and uncertainties are listed in our SEC filings. We have no obligation to revise or update any forward-looking statements except as imposed by law as a result of future events or new information. Supplement the financial results presented in accordance with generally accepted accounting principles. FRP presents certain non-GAAP financial measures within the meaning of Regulation G. The non-GAAP financial measures referenced in this call are net operating income, or NOI, and pro rata NOI. FRP uses these non-GAAP financial measures to analyze its operations and to monitor, assess, and identify meaningful trends in its operating and financial performance. This measure is not and should not be viewed as a substitute for GAAP financial measures. To reconcile NOI to GAAP, please refer to the segment entitled Non-GAAP Financial Matters in our most recent earnings release. Any reference to cap rates, asset values, per share values, or the analysis of the estimated value of our assets net of debt and liabilities are for illustrative purposes only and as a reflection of how management views its various assets for purposes of informing management decisions and do not necessarily reflect the price that would be obtained upon a sale of the asset or the associated cost or tax liability. I will now turn the call over to our CEO, John Baker III, to discuss the recent announcement. John?
Thanks, Matt, and good afternoon to those on the call. Earlier this week, we announced the completion of an important strategic acquisition that expands FRP's core industrial business development platform. This acquisition, which closed on October 21st, 2025, adds a number of development projects to our existing and growing portfolio, including raising FRP's ownership interest to 100% in two projects in Florida currently under development and scheduled for completion in 2026. This transaction both broadens our exposure to high-quality industrial assets in key markets, as well as deepening the bench of our team. Now let me review the terms of the transaction. FRP acquired minority membership interests in 5 joint ventures and took an assignment of a land sales contract from Altman Logistics, LLC, for a total purchase price of $23.6 million, plus a requirement to replace a $10 million guarantee fund that serves as collateral for the existing construction loans. At closing, $42.5 million of the $121.8 million in total construction financing for the projects had been drawn, with FRP's proportionate share currently at $4.9 million. The company expects to record additional liabilities and expenses between now and the sale of the projects related to employee compensation tied to promote participation for successful projects. In the release accompanying this announcement, we included a table which details the projects being purchased with this transaction, inclusive of the 2 projects that FRP already had an existing partnership with Altman, and which FRP now owns 100%. The Altman Logistics Properties model consisted of a develop and sell program whereby Altman collects development fees from its joint venture partners and holds the right to promote upon a successful sale of the project at stabilization. Exclusive of the 2 properties that FRP will now own 100% of, the company intends to continue the Altman Logistic Properties model for these other projects, which the company estimates will generate a 15 to 20% IRR at the property level prior to any promotes the company would be entitled to receive. The Reader's Digest version of what we expect to achieve with this deal is that upon stabilization of our 5-year development pipeline, we will be able to execute our stated goal of doubling our NOI, as well as growing FRP's sum of the parts valuation to over $1 billion. The finances of this deal are obviously attractive to us. Through the promotes and sales we expect their team to achieve on these deals in place, we are going to generate a significant amount of cash that will help fuel future development more in line with the traditional FRPH model of in-house development for the purposes of holding and managing assets. But to me, what pushes this deal from attractive into the realm of necessary is the people. At our Investor Day event earlier this year, we presented a growth plan to more than double our run rate NOI by the end of this decade, centered around a substantial investment in and growth of our industrial portfolio. We detailed an extensive plan and a pipeline of projects with the goal of delivering 3 new industrial properties every 2 years across the back half of this decade. In order to make that possible, we knew we needed to bring on at least 3 people who would hold meaningful positions in the company. Those hires would have to be talented, capable people who fit our culture and share our values. What this deal accomplishes, in addition to being financially accretive, is to complete this whole process in one step. Rather than hiring, training, mentoring, and professional growing a new crop of employees to get us where we need to be, we have acquired wholesale a talented team that we know and trust with a proven track record, deep contacts, and expertise in markets well outside our current reach. We have broadened our bench and greatly expanded our bandwidth and done it with a known commodity, leapfrogging the lengthy process of professional development and internal growth that might have taken a decade to achieve if done organically. Over the last 40 years, the long-term movement of interest rates and cap rates have made it difficult to differentiate between the pretty good and the truly talented. In this current environment of interest rate and cap rate uncertainty, talent is going to be the only differentiator we can count on to deliver value to our investors. The ability to identify growth markets, leverage contacts for off-market deals, control construction costs, and get a building occupied and stabilized quickly with quality tenants is going to be everything. In closing this transaction, we now have a deep bench of proven professionals who can do just that and can accomplish in-house what we would have had to pay for through development fees and equity had we pursued a deal via a joint venture. We have for some time laid out an ambitious plan for growth, and this certainly adds to it. Now we have the team that can deliver it and then some. At this point, we'll be happy to answer any questions you might have.
At this time, if you would like to ask a question, please press the star and 1 on your telephone keypad. You may withdraw yourself from the queue at any time by pressing star 2. Once again, for your questions, that is star and 1. We'll pause a moment to allow any questions to queue. Once again, that is star and 1. And we'll take our first question from Kevin Amirsaleh with Via Misner Capital LLC. Your line is open.
Hi, guys. Sorry, I might have missed this, just joining the call, but could you just speak about if the future direction, is this just an opportunity came your way, or is this a strategic, fork in the path for FRPH? What is your thinking and sort of the flavor here going forward on development?
Hey, Kevin.
And what you guys are going to lean into? Hey.
Hey, Kevin. This is John Baker. It's really an opportunity that came our way. Altman approached us. They were kind of at an interesting point in their company's trajectory. Their overall, majority shareholder was looking to wind things down, and we had a relationship with their industrial team, and they approached us about, potentially taking their team on and taking on the projects that they have, under consideration. I don't think, a year ago, if you'd asked us if we'd be in the, fee development business, that's not a strategy we necessarily would have pursued. What we did know, a year ago was that in order to get where we wanted to be, we were going to have to make some serious hires and take on, real quality people, kind of what David III was to his dad when he was president of FRP Development Corp. So the taking on of additional employees was something we knew we had to do, and when this opportunity presented itself, and you had a team of people that we knew, trusted, we knew were really talented, and had the opportunity to take them on. The question was, okay, the fee development business, what does that look like? What does that look like for us? And so that was, essentially our due diligence. And, what I think, I don't know necessarily that long-term we're going to be in the fee development business. It's a really wonderful muscle to be able to flex if we want to. And what I do know is that the projects that they have are going to generate serious amount of cash for us, and that's going to be able to fuel kind of our more traditional model of developing things in-house. And, the other benefit of this transaction is, had we kind of proceeded as planned and made additional hires, just assuming that those hires worked out perfectly, which I think anyone who has ever hired anyone, that's not a guarantee. The beauty of, the Altman team is that they're in a completely different market. It's essentially like opening up a new office, and, they are focused on markets that we really haven't been able to touch and wouldn't have been able to touch unless we'd done it, in the kind of more expensive form of a JV. So, their market contacts in South Florida, Central Florida, tri-state area really, broadens our market outreach, and I think that's kind of the big strategic shift, if anything.
Yeah, and I just add, Kevin, just because you mentioned fork in the road, I just want to be definitely not a fork in the road. I think this is just something that is in place now that will play out with these guys. But the long-term vision is to take this team and meld them into our core, vision of building assets for ourselves and owning them long-term. And so there'll be a shift out of, over time, we may do some more fee development projects, but ultimately they'll roll into our, normal development program. And then to John's point, if we wanted to flex that muscle and do a fee development because it was really attractive, we'd have the capability to do that once in a while.
Gotcha. And so just to follow up, if I may, like you said, this is doubling the size of the employees. This is a pretty substantial growth. This team gives you an ability. You talked about your vision for the company. What ability ultimately, not necessarily what's in front of you in 6 months, but what ability do they give you, and what is this? You envision. What is it you envision? What is that capability they give you, and what this team will do for FRP in the long run? Kind of what are your ambitions here?
Well, one thing to clarify, and I'll let somebody else field that call. I think I heard you say doubling the size of the employee base, which is, if that was heard, that was not right. We've got a little over 20 today. We added six new people with this deal.
60 people. Okay, thank you for that. So yeah, I mean, what does it enable you to do? What part of the puzzle does this fill in? Not necessarily for 12 months, but more the vision around what you guys are doing. What have you just unlocked?
I mean,
go ahead, David.
I'll touch base on one aspect of this. This team is entrenched in South and Central Florida. An area that we don't have development boots on the ground. We just don't have people down there. We're more concentrated up here in Maryland. So, this group of people really opens us up to a new geographic location in South Florida, and also up in New Jersey, New York, Pennsylvania. The Northeast market and that Southern market are two markets that we want to be in. We like the market characteristics. We like the demand drivers. And this team allows us to get into those markets really, really well. They already had traction there, and, we're jumping on that traction and looking to scale that. So this team allows us to do that, allows us to do that today. It allows us to do that in a year, 2 years, 10 years. And that's something that's really, really exciting. Mark Levy, he worked for Prologis. He worked for JLL. He's worked with Hilco. He's been up and down the East Coast for a while. His black book and the amount of people that he knows is wide and deep. So we are going to see a lot more deal flow. We're going to see a lot more opportunities, and we're going to be able to really, scour a lot of deals to pick the ones that we really, really like. So those two things, more deal flow and access to these geographical markets that are different than the Mid-Atlantic, are really, really exciting, and something that they bring today and 10 years from now.
Gotcha.
We'll take our next question from David Foley with Estabrook. Your line is open.
Thank you, and thank you for taking my question. I guess the previous caller kind of asked a handful of things, but how many? I guess two parts of this is is there a square footage level that you guys, I thought a couple of years ago, and this might be more than a couple of years ago, you wanted to get back to around 1 million square feet, and you used the term doubling your NOI. Is there a number that in your minds of saying, I'd like to get to this level? And some of that is, it seems that, a long time ago, you kind of had some industrial space in the Maryland area, and it was probably a little bit smaller in terms of the buildings you were building, and you'd sort of build one building and get it entirely leased before sort of breaking ground on the next one. And we're obviously in a bit of a different place here. But is there a sense or a direction that you'd like to go to before you'd say, well, let's catch our breath and generate enough cash here to perhaps give a dividend, which would make some shareholders elated, as to where you want to be, I guess?
I don't know if there's a square footage cap exactly that we have in mind, but think at a certain point in the next, basically 5 years and beyond, the projects that we have, on hand are going to be developing or generating, I think, more cash than we'd feel comfortable employing year in, year out. And that's when essentially, not that we'd be a mature company, but when you've got more cash than you have projects to deploy it in, that's when you're returning capital to shareholders.
Yeah, and David, just so you know, and I'm sure it's pretty clear, this transaction, we would have ended up buying, the extra 10 and 20% of Lakeland and Davie, upon stabilization.
At some point.
So that would have added, that kind of was already in our square footage. We're not really adding any square feet with the other projects in this deal because we'll sell them in the next 3 to 4 years. So they'll just be developed and sold and collect the promotes and generate the cash for future projects. But I think in my mind, I think we've kind of said that in the next few years, we think we'll be at like $1.2 billion with the projects in the pipeline. And I could see, 5 more years after that, adding another $750 to $1 million, I think is probably in our program.
Yeah.
And so, in 10 years, maybe being around $2 billion.
that the apartment sort of component of the company is sort of on a holding pattern until that market gets more attractive in what is remaining in the DC area and perhaps in some other places where you've made some investments?
I don't know about holding pattern. I think there's still apartment markets that we are excited about and don't want to, completely abandon. I think we're really happy with Greenville. We've got a project that we've invested in and right outside of Fort Myers. But I think, as we said before, I think our focus is industrial. That is going to be the brunt of our, CapEx and sweat equity. But I don't think we're abandoning apartments by any stretch of the imagination.
Yeah, we do have an active project right now that just broke ground in South Carolina, the Woven project. So we have two multifamily projects that are active, but it's certainly not, to John's point, it's not the heft of what we're actively doing. It's we have 25% or something of what we're doing, and we'll just wait and see on DC. We've got a lot of projects up there to do, but we're not in a hurry to do them until we kind of see the market get, better.
Yeah.
Yep. All right. Thank you.
Thanks, David.
Thanks, Ed.
We'll move next to Stephen Farrell with Oppenheimer. Your line is open.
Good afternoon.
Hey, Stephen.
Hey, Stephen.
I just have a quick question on the impact to the income statement here. What will be the cost of overhead of bringing the team on?
The team is, it's kind of shifted over time, but I think the cost of the team is probably going to be somewhere in the $3.5 to $4 million range annually. We'll collect each year somewhere around half of that. I'm just going to use round numbers in development fees that'll cover that cost. You're looking at probably a net $1.5 million or so, $2 million.
And you mentioned, for now you're just going to finish these. The other three projects you'll do is develop to sell, and focus on the FRP developments. Is there more bandwidth? Maybe increased. The goal was 3 every 2 years. It seems like now they got 5 going on in the pipeline at one time. So does that pace change at all?
For in-house projects, no. That's still kind of our North Star right now. It's just that we'll have, on top of that, these projects that are currently under development, and then there are some of the projects have additional phases that we have an obligation to see through. And an opportunity to see through. It's probably a much better way of saying that.
And then with the future developments, do you think that what you're trying to do would sort of replicate the old structure of when you had the prior industrial developments where they'd have debt and less likely to use JVs then?
Yeah, I think we're less likely to use JVs at this point. I mean, that's sort of the beauty of this team is that the markets we want to be in, which we would have had to JV into, now we don't have to. And so, I think beyond what we currently have planned, we expect to see more projects in the South Florida, Central Florida, Tri-State, Pennsylvania area, and think we'll certainly get through this first phase of develop and sell, collect fees, get promotes. I think what you might see after that is kind of a hybrid of our program with theirs, where you might do 2 projects where you're and maybe, bigger projects, certainly different markets where you can bring in institutional capital, you can be the GP on a deal, collect fees, earn a promote, and then you probably put debt on those, and from there you could either sell them, you could buy out your partner, you could own it together. I think this just opens up a lot of possibilities for us.
And I know it's not a pivot, like you said, but there is a bigger focus on industrial development. Personally, I feel like with the housing in short supply and lack of new developments coming on, now is a better time to be leaning into that side. Do you envision that at all, or are we kind of at the pace that we've been going the last 2 years?
I don't think we're going to ramp up our multifamily development program, but we still have, plenty of projects in the hopper. I think that's what we've always considered the beauty of our company and our strategy is, we have irons in several, asset class fires, and if the apartments are kind of where they were 5 years ago, then, there's nothing stopping us from moving ahead with, Stewart Phase 1, with Anacostia Phase 4, Phase 3. Our goal with any project that we have under development is to be, shovel ready as soon as possible, so that when it's time to go, we can go.
Yeah, and just again, we currently have a project that's a pretty large project underway. It just broke ground in the last couple of months in South Carolina that I want to say we're about a 70% owner of.
Mm-hmm.
And then we've got a project in Fort Myers, Florida, where we're a much smaller partner. We're 15%, but it's a 2-phase project that's a multi-use, mixed-use project with retail and some other things. So we're still in there. And actually, if you looked at it compared to the last couple of years, this is probably more active than we've been the last couple of years in the apartments. So, and then we're still working on entitlements and things up in D.C. as we speak. I think David, you can probably speak to this, just got approval for Phase 3 and Phase 4 as apartment buildings the way we wanted them and with a time frame that makes sense. I think it gave us 3 years to break ground on the first one. So we're just keeping an eye on that D.C. ball, and if things improve in the market, they're not bad. The rents are fine. We just had a glut of projects kind of come on in our area, 2 or 3 projects in the last few years, and those are starting to lease up. So hopefully that'll get done, and rents will increase, and we'll see a good opportunity to jump back in there.
Yeah. Yeah, we're not rooting against multifamily by any stretch of the imagination.
Yeah, no, I echo all that. I think industrial is a pillar of our strategy, but multifamily and other asset classes remain important. I think as everyone has seen, I think we've always taken a diversified approach to investment and development as a strength. Sometimes we lean in on multifamily, sometimes we lean in industrial, and it really has to do with the market and the opportunity that's there. Multifamily right now in D.C., I don't think it's the right time. Will it be in the future? Probably, and we'll be ready for that. Our multifamily project down in Greenville, South Carolina, we got some tax breaks, we got some textile credit money, and the market is there right now. So we saw that as an opportunity, and we're pursuing it, and we're looking with all of these to make sure that there's a path to long-term value creation. That's kind of our North Star. The things have to pencil. It has to be a good opportunity, and it's got to create, value. And if those boxes check, then it's something that we'll pursue.
And the number of, excuse me, number of opportunities for industrial development in Maryland haven't been as abundant as they once were, and that's what led to the Florida JVs, and this gives you optionality on tri-state as well. But how do you view just the overall market in those areas and risks of overbuilding and kind of doing this acquisition now, and then if we get into a scenario where we're oversupplied, and how are you gauging the risk of this transaction and sort of a market and downturn?
Yeah, Steve, I think that's a really good question, and obviously, one that we've factored into our investment strategy. And kind of what we've seen is that the big box 900,000 square foot buildings and above, that have a lot of institutional money behind it, that I think there has been some oversupply in that regard. But the kind of sandbox we play in, your 100, 150, 250,000 square foot buildings, shallow bay industrial, that's just not at the level of investment required to get institutional capital behind it. And, it's kind of a pain to develop. I think when you do see institutional capital come in, it's purchasing a building that's already been built and stabilized. So right now, the asset class that has always been our bread and butter is still relatively undersupplied.
And these buildings are all spread out, and they're not, any of these buildings really are in the same market as the other. So certainly a downturn. I think I heard you say downturn. I mean, that's going to affect every market in the country. And, it would not be wonderful, obviously. We are mostly a 10% owner in these buildings. And so we would be able to, carry our weight, assuming, and our partners in these deals are big player, institutional players. So I think we could weather a downturn. We certainly are rooting for it. But I think the diversification of locations is helpful in that regard. None of it's overlapping.
Thank you. And then just last question. I know you mentioned getting to $1 billion, some of the parts, and at that point you'd probably have more cash than you'd be willing to redeploy each year. So what is the end game then? Are you building to get to that point and sell, or building to get to that point and maintain and do one-off and lower level of development after that?
Yeah, I think our goal is to just keep getting bigger. We want to grow the value of this company, and so I don't. Everything's for sale, but that's not part of our strategy. We want to invest in quality assets and generate substantial cash flow once we've reached a certain portfolio size, and once we do, it doesn't. If we double the size of our portfolio, it doesn't mean we're gonna necessarily double the size of the investment we put out every year. So that's when we reach a point where we're generating more money, then we're gonna put back into it. That's where you're gonna see a return of capital.
Yeah, this next 5 years is kind of the the cycle that we're going to draw down cash and invest, and then towards the end of that is in the plan is when cash starts to grow pretty steadily going forward, using our normal development investment amount, kind of our staying flat on CapEx. So I think to John's point, there's an opportunity there to start looking at returning shareholders, whether it's repurchases or something else. And that's kind of where the eye on the ball is. Let's get through these next few years and get this plan, stabilized, and then take a look at it. Yeah.
Thank you. That's all I have.
Thanks, Stephen.
We'll move next to Bill Chen with Rhizome Partners. Your line is open. Bill, you may need to check the mute function on your device or access your handset.
Hi. Can you help me understand the, on the purchase price? Kind of, you explained the $10 million. That's there's a bank account. How much is that really just kind of like dollar for dollar that you took over?
Yes. It was dollar for dollar. We had to. That was a yes. Yep. It was a $10 million collateral account, essentially, required by some of the loans under these JVs, and we basically just replaced Altman's $10 million with our $10 million, so it's just our cash.
Okay, got you. And then on the, can you give an opinion on the $23.6 million? It seems like you took over a bunch of minority interests. Love to hear your thought on, like, was that at a discount? How do you feel about the positions? For 10% of Lakeland, 20% of Davie, and then 10% of Delray Beach, which that property seems like it's almost done. So, love to hear your thought on that.
I mean, Bill, I'll give an opinion of that. Look, we would not have done this if we didn't think it was a good deal. One, two, I would say that a portion of this purchase price was really about acquiring the team, and that price was sort of based on the fees associated with the projects that they had in the pipeline. So there was a piece of it that kind of was the team members. The other part of the purchase price was really, at cost with, let's just say, a 20% premium on the cost. And we're stepping in, to your point, at a time when these buildings are well under development, if not under roof, and a lot of the due diligence, legal, all those costs to kind of get it to where it was, were done for us and worth that premium and then some. So, the purchase price I look at as very, very favorable. The proof is going to be in, the next couple of years where we get at least stabilized, we value these things. And the ones that we're keeping, Lakeland and Davie, what type of returns, earnings we're getting on those. And the other ones, what type of sale price we're getting. But the basis that we have in these things, that purchase price, I feel really good about and look forward to seeing what fruit this bears, 2-3 years down the road when it's stabilized and or, we sold it.
That's helpful. And approximately what's kind of the estimated LTV on some of these projects you're stepping into?
LTV, I just want to make sure we're talking about the same kind of loan to value.
Yeah.
I can tell you now that, all of these are under a construction loan, and all of those are kind of 55% loan to cost.
Okay.
So they're not highly leveraged. Most of these, or all of them are floating to SOFR, and I look forward to seeing what the Fed does. But so far, they're going in a direction that's very helpful to us. Lower construction interest is always better when we're developing these things. And if we keep them, I think we've always been very prudent with our permanent financing to make sure the loan to value makes sense. And if there's a couple bumps in the road, we're still able to, meet the covenants. And if not, if we have to pay something down a couple bucks, we've got the capacity to do it. So we're excited about the capital stack now in terms of equity and construction, and look forward to getting these stabilized and making good decisions for permanent financing.
That's helpful. And I believe you said that the other 90, I know Lakeland Davy, it's FRP, but the other four, the other majority investors are institutions and endowments, if I heard that correctly earlier.
They are. Some are institutional. Others are. I'll call it. Family office investments. But again, we've got Deutsche Bank, PCCP. We've got some good partners. And we're excited to know them. I think that there's going to be some good opportunities based on our equity partner side and also our debt partners. We've met people from Truist and Synovus and City National Bank and Seacoast. And, again, just having those contacts and having, access to different players in this market is exciting.
I have no further questions. Thank you for that.
Thanks, Bill.
Thanks, Bill.
There are no further questions at this time. I would now like to turn it back to management for any additional or closing remarks.
Thank you to everyone for your interest and questions in this transaction and your continued investment in the company. This is a deal that we are really, really excited about, and we intend to deliver on that, that excitement and hope. So thank you again to everyone.
This does conclude today's program. Thank you for your participation. You may disconnect at any time and have a wonderful afternoon.